Welcome to today's IFRS webinar. Today we are going to be covering IFRS 5, the standard dealing with non-current assets held for sale and discontinued operations. IFRS 5 is a long-standing IFRS standard. It may not be considered as glamorous as the new IFRS 15, IFRS 16, IFRS 9. However, it is a standard which is continuously relevant. And the reason why is because there is often situations or cases where preparers are disposing of various investments for various reasons, various assets, etc., and therefore IFRS 5 is applicable. In addition, given the global economic condition or climate, you are seeing it more frequently where entities or groups are being forced to dispose of assets or investments. And in addition, regulators are becoming more thorough in their reviews of financial statements, often resulting in there being questions asked about the appropriateness of the classification and the measurement, etc., where there has been the application of IFRS 5. So today's session is ultimately going to be a recap and a refresher of the requirements and guidance of IFRS 5. My name is Bridget, and I'm going to be the IFRS consultant taking you through today's webinar. What we will be looking at in detail today is how an entity should account for non-current assets and disposal groups held for sale and/or assets or disposal groups held for distribution to owners being the shareholders of the company. A quick high-level summary of what the consequences are if an asset or a disposal group is classified as a non-current asset held for sale or disposal group in accordance with IFRS 5. Assets classified as such are not depreciated from the date at which they are classified in terms of IFRS 5. They are to be measured at the lower of their carrying amount and their fair value less cost to sell. They are also required to be presented separately in the statement of financial position, and IFRS 5 requires specific disclosures to be made where there are discontinued operations and around the disposal of non-current assets. All of this is going to be dealt with in more detail over the following slides. Just like any other IFRS standard, the first thing that we need to consider is the scope, as IFRS 5 can only be applied to those items which fall within the scope of IFRS 5. IFRS 5 provides the classification and presentation requirements for all recognized non-current assets and disposal groups held for sale. There are certain assets which may fall within the scope of IFRS 5, therefore are subject to the classification and presentation requirements. However, they are specifically excluded from IFRS 5's measurement requirements. These items must then be measured in accordance with the other relevant applicable standards. Even though these assets are to be measured in accordance with other standards, they are still subject to be classified and presented in accordance with the requirements of IFRS 5. We will go through what these assets are a little bit later. Before we go into the detailed requirements of the standard, let us first get familiar with some useful definitions. A non-current asset is an asset that does not meet the definition of a current asset. Current assets are defined in terms of IAS 1, which is the IFRS standard which deals with the general presentation requirements of financial statements. IAS 1 defines, or it says that a current asset is an asset which an entity expects to realize or intends to sell or consume it in its ordinary operating cycle. It holds the asset primarily for the purposes of trading. It expects to realize the asset within 12 months after the reporting period, or the asset is cash or cash equivalent unless the asset is restricted from being exchanged or used to settle a liability for 12 months after the reporting period. Therefore, if an asset is identified as a current asset, it would not qualify individually to be recognized as a non-current asset held for sale in terms of IFRS 5. What is an example of a current asset? Let's think about an asset identified as inventory in terms of IAS 2. Inventory would not, on its own, qualify to be a non-current asset held for sale, as inventory, although it is held for sale, it is within the purpose of trading, and it is expected that it is going to be realized in the normal operating cycle of an entity. An example of what is a non-current asset. Let's think about a scenario where there is a parent entity who holds an investment in a subsidiary. If we think about the parent's separate financial statements, their investment in the subsidiary is likely to be classified or identified as a non-current asset held for sale, assuming that that parent entity is not holding that investment for trading. The next definition that we are going to look at is that of a disposal group. A disposal group is a group of assets to be disposed of, by sale or otherwise, together as a group in a single transaction, together with any liabilities directly associated with those assets that will be transferred in the same transaction. In other words, it consists of a group of assets and the associated liabilities which will be disposed of together as part of a single indivisible transaction. A disposal group also includes any goodwill acquired as part of a business combination if the disposal group identified is a cash generating unit to which goodwill has been allocated in accordance with IAS 36. A disposal group might consist of a group of cash generating units, or a single cash generating unit, or a part of a cash generating unit. Some common examples of what a disposal group could be is a subsidiary held for sale, or a cash generating unit identified in accordance with IAS 36. Let us consider the first example, where there is a subsidiary held for sale. If we consider a group's consolidated financial statements, the subsidiary's assets and liabilities are recognized in full. In other words, 100% of all the assets and 100% of all the liabilities are recognized in the consolidated financial statements. If the parent entity within the group plans to sell the subsidiary, in other words, it is going to dispose of all the assets and all the liabilities of that subsidiary as part of a single indivisible transaction, remember, this now meets the definition of a disposal group, and the criteria of IFRS 5 are met, then all of those assets and those liabilities combined represent a disposal group. And the requirements of IFRS 5 are then going to be applied to all of those assets and those liabilities together. Some of you might have noted that as we went through the previous slides, I was making references to disposal of groups of assets and also made mention where assets are disposed of individually. And the reason why is because of such. When an asset is sold individually, IFRS 5 applies only if that individual asset is itself a non-current asset. Remember my previous example of inventory. Inventory is not a non-current asset, and therefore IFRS 5 is not going to apply on its own, even though inventory is or may be held for sale. However, when a group of assets is disposed of as part of a single transaction, in other words, we have identified a disposal group, the classification and presentation requirements of IFRS 5 apply to the disposal group as a whole. So if we now go back to my subsidiary example, the disposal group consists of all the assets and all the liabilities which are going to be disposed of as part of this indivisible transaction. This group of assets could include current assets. For example, the subsidiary might have had inventory on their statement of financial position. In this instance, even though individually the asset would not qualify for IFRS 5 application, because this current asset forms part of the disposal group, it is then going to be included in the presentation and classification requirements as required by IFRS 5. The last definition that we need to consider before we can start going through the detail of IFRS 5 is that of a discontinued operation. Previous definitions that we have gone through where we have considered non-current assets held for sale and disposal groups, those are items which are going to bear an impact to the presentation and classification of items on the face of the statement of financial position. A discontinued operation is going to have an impact on the presentation and classification of items on the face of the statement of profit and loss and other comprehensive income. A discontinued operation is defined as being a component that has been disposed of by year-end, or it is classified as held for sale. In other words, it met the criteria to be classified as a non-current asset held for sale or disposal group at reporting period. And it represents a single major line of business or geographical area of operations, or is part of a single coordinated plan to dispose of a separate major line of business or geographical area of operations, or it is a subsidiary acquired exclusively with the view to resell. Earlier I mentioned that there were certain items or assets which although fell within the scope of IFRS 5 for the classification and presentation requirements, they were excluded from the measurement criteria or the measurement requirements of IFRS 5. And we stated that those items should be measured in terms of the other relevant applicable standards. This slide now lists the detail of these assets which are excluded from the measurement criteria of IFRS 5. So as the slide reads, IFRS 5 measurement requirements do not apply to the following when they are held for sale. So in other words, these assets might still be identified as non-current assets held for sale or might still be assets included in a disposal group. Deferred tax assets. These are to be measured in accordance with IAS 12. Assets arising from employee benefits. These are still to be measured in accordance with IAS 19. Financial assets within the scope of IFRS 9. That is the standard dealing with measurement, classification, presentation, etc. of financial instruments. If there is a non-current asset which is accounted for at fair value in accordance with IAS 40, the standard dealing with investment property, or a non-current asset that is measured at fair value less cost to sell in accordance with IAS 41, that is the standard which deals with biological assets, or the asset is a contractual right and an insurance contract as defined in IFRS 4. So these assets could still be included in a disposal group. They might still be identified as being non-current assets held for sale. They are still subject to the classification and presentation requirements of IFRS 5. However, they are not subject to the measurement requirements of IFRS 5. Let us now get to the classification and presentation guidance of IFRS 5. An entity shall classify a non-current asset or a disposal group as held for sale if its carrying amount will be recovered principally through sale in a transaction rather than through continuing use. There are specific criteria which need to be met. Note, all of these criteria need to be met in order for IFRS 5 to apply. So the held for sale criteria in accordance with IFRS 5 state that an item is only to be classified as a non-current asset held for sale or disposal group if the carrying amount is going to be recovered principally through sale or distribution to owners rather than through continuing use. It must be available for immediate sale in its present condition, only subject to the usual terms for sale of such an asset, and the sale must be highly probable. Management must be committed to plan to sell. They must actively be looking for a buyer. The asset must be marketed at a reasonable price, and the sale should be highly probable to occur within 12 months of the date of classification. Highly probable is not defined in IFRS. Probable is kind of understood to represent a 50% chance or more. Therefore, some might interpret highly probable to say a plus 75% probability threshold. Determining the appropriate point in time at which this classification to a non-current asset held for sale is very relevant, as it is on this date that certain impairments or remeasurements are going to be required, and there may be instances where judgment is going to be required in determining what is the appropriate point in time at which an entity should conclude that the criteria are met. So the previous two slides made a point of stating that these are going to be assets which are going to be realized through disposal or distribution to owners rather than through continuing use. There is specific guidance in IFRS 5 that says non-current assets that are to be abandoned are not classified as held for sale because it is deemed that the carrying amount will still be recovered through continuing use. Its use is just, however, abandonment. Abandonment does not mean that is going to result in a sale or a distribution to owners, and therefore IFRS 5 does not apply to non-current assets that are to be abandoned, and in addition, it is not going to be applied to assets that are temporarily taken out of service. So in other words, if there is an item of PPE or property, plant and equipment that is temporarily decommissioned or might be standing idle, you are not going to apply IFRS 5 to that asset. In the case of a non-current asset that is to be abandoned, there is certain guidance in IFRS 5 which states that if certain criteria are met, then the results and the cash flows of that asset which is to be abandoned should be presented as a discontinued operation at the date on which it ceases to be used, i.e. on the date at which it is abandoned. If we look at the criteria on the slides, these are the criteria for the identification of a discontinued operation. So therefore, if the asset or the group of assets that is being abandoned meets the definition of a discontinued operation, then you can go and apply the discontinued operation presentation guidance in accordance with IFRS 5, which would result in disclosure on the face of the statement of profit and loss and other comprehensive income, as well as disclosures on the face of the statement of cash flows. Let's now consider how some of the held for sale criteria should be assessed in more detail. The one criteria was that a sale must be highly probable to occur within 12 months of the date of the classification. This 12-month limit can, however, be extended if there are events or circumstances which are beyond the entity's control, which result in the sale period extending beyond 12 months, and there is sufficient evidence to demonstrate that the entity is still committed to a plan to sell the asset. The appendix to IFRS 5, Appendix B, contains some additional guidance for when an extension is appropriate and does not disqualify the entity from applying IFRS 5 to the disposal of that asset or that disposal group. An extension shall apply in the following three situations. Firstly, when an entity commits itself to a plan to sell a non-current asset or disposal group and it reasonably expects that others, not being the buyer, will impose conditions on the transfer of that asset or the disposal group that will extend the period required to complete the sale, and the actions necessary to respond to those conditions cannot be initiated until after a firm purchase commitment is obtained, and a firm purchase commitment is highly probable to be obtained within 1 year. IFRS 5 also defines what a firm purchase commitment is. A firm purchase commitment is defined as being an agreement with an unrelated entity, binding on both parties, usually legally enforceable, that specifies the terms such as the price, the timing of delivery, transfer, etc., and it includes a disincentive for non-performance that is large enough to make performance highly probable. The second exception to the one-year rule is in a situation where the entity obtains a firm purchase commitment, as we've previously defined, and as a result, the buyer or others unexpectedly impose conditions on the transfer of that asset or the disposal group that will result in the period extending beyond 12 months. If so, the entity must demonstrate that any timely actions necessary to respond to the conditions have been taken and a favorable resolution of the delaying factors is expected. The last situation, and this is the one which is most commonly seen in practice, is an exception in a situation where, if during the initial one-year period, circumstances arise that were previously considered unlikely or remote, and as a result, the held-for-sale non-current asset or disposal group is not sold at the end of that reporting period, then if so, the entity must demonstrate that during that initial period, it took all necessary action necessary to respond to the change in circumstances. The asset or the disposal group is still being actively marketed and priced at a reasonable price given the change in circumstances, and the held-for-sale criteria are still met. If we consider this example, let's assume a situation where there is an asset which meets the criteria to be classified as a non-current asset held for sale. However, in the next couple of months, the value of the asset significantly decreases in the markets. And it is owing to now the price that the entity is marketing that asset at that is causing the delay in the actual time of sale of that asset. One would expect that an entity is going to reduce the price of that asset. So if they continued to market the asset at that original price, they would not be able to actually rely on this exemption because they would not be able to demonstrate that they have taken into account the changes in circumstances and that it is still being marketed at a reasonable price. The standard contains more guidance specific to certain types of assets or transactions. If the sale involves the loss of control of the subsidiary, it is necessary that there is the classification of all of the assets and the liabilities of that subsidiary as held for sale when the criteria are met, regardless of whether or not the entity is going to retain a non-controlling interest in the entity after the sale. Because remember, for so long as an entity or a parent controls a subsidiary, you are consolidating 100% of all the assets and the liabilities of that subsidiary. If you lose control, you are deconsolidating 100% of those assets and liabilities. Any retained investment is going to be accounted for in accordance with IFRS 11 or IAS 28 or IFRS 9, depending on the nature of the investment which is retained. When an entity acquires a non-current asset or a disposal group exclusively with a view to sell this asset, the standard allows for that asset or that disposal group to be classified as held for sale or as a disposal group at the date of acquisition, only if the one-year requirement is met, and it is highly probable that any other criteria which were not met at that date shall be met within a short period of time following the acquisition. It is accepted that those conditions should be met usually within 3 months of the date of acquisition. So therefore, if you are acquiring an investment or an asset or a disposal group with the intention to dispose of it, it might fall into the IFRS 5 classification and presentation requirements from the date of acquisition. What happens though if those criteria to classify an asset or disposal group as a non-current asset held for sale are met only after the reporting date? The question is this considered to be an adjusting or a non-adjusting event in accordance with IAS 10? The standard is quite specific in that it states that when the criteria for classification are not met until after the reporting date, you will not go and reclassify retrospectively. In other words, if the conditions or the criteria are only met after the reporting date, it is a non-adjusting post-balance sheet date event. Depending on how significant it is, there might be additional disclosures as is required by IAS 10 and IFRS 5. When the criteria are met after the reporting period, but before there is the authorization of the financial statements, the following information is required to be disclosed in accordance with IFRS 5. A description of the non-current asset or the disposal group, a description of the facts and circumstances leading up to the expected disposal and the expected manner and timing of that disposal, and, if applicable, the reportable segment to which that non-current asset or disposal group relates. That is, if you are applying the requirements of IFRS 8. Okay, so up until now we have gone through some definitions and we have also gone through the criteria which need to be met in order for an asset or disposal group to be classified in terms of IFRS 5 as a non-current asset held for sale. The next question is, what happens with regards to the measurement of these assets once they are classified in accordance with IFRS 5? So the requirement of IFRS 5 is to measure a non-current asset held for sale or a disposal group at the lower of the asset's carrying amount or the fair value less cost to sell or to distribute this asset or the disposal group to owners. If a newly acquired asset meets the held for sale criteria at the acquisition date, in other words, it is acquired to resell, it is measured at the fair value less cost to sell. If a sale is expected to occur beyond 1 year, it is necessary to measure costs at their present value. So in other words, time value of money would need to be taken into account if the sale is expected to occur beyond the 12-month period. What does this measurement guidance mean though in reality? It means that at the date at which there is the reclassification of the asset or the disposal group in accordance with IFRS 5, in other words, the date at which those criteria are met, there would be impairment losses recognized. Subsequently, once the asset is classified in accordance with IFRS 5, the requirements are that that asset needs to be carried at the lower of its carrying amount or its fair value less cost to sell. So therefore, there may be additional impairment losses recognized once the asset has been classified in accordance with IFRS 5. If there has been impairment of an asset, or if there's been impairment of a group of assets in a disposal group, there would need to be allocation of that impairment across the assets making up that group. The normal rules of allocation in terms of IAS 36, the standard which deals with impairment, are going to be applied in that scenario. If there is a subsequent increase in the fair value less cost to sell, IFRS 5 allows for you to go and reverse some of that impairment loss which has previously been recognized. It is necessary to consider what is the value of the impairment that has been recorded, because you cannot go and reverse back an amount which exceeds any previous impairment which has been recognized or recorded on that asset. Now we have gone through the classification and the measurement guidance of IFRS 5 dealing with non-current assets held for sale and your disposal group. So now the next question is, well, what is the impact of this held for sale classification other than its measurement impact? So assets that are classified as non-current assets held for sale are going to be reclassified to a separate category of assets on the face of your statement of financial position. Typically, you see a separate line item disclosed, titled, or described as being non-current assets held for sale. And it's necessary to remember that this held for sale asset is going to be measured at the lower of its carrying amount or its fair value less cost to sell initially and subsequently. So therefore, it could result on an impairment losses on initial classification and subsequent to the date of reclassification. From the date an asset is classified as an IFRS 5 non-current asset held for sale, depreciation on that asset is going to cease. In addition, as I have mentioned, there's going to be the separate presentation on the face of the statement of financial position. In a situation where there is a disposal group and there are both assets and liabilities which are going to be disposed of as part of the single indivisible transaction, it is necessary to note that you cannot and should not offset those assets and liabilities. In that instance, there is going to be a separate line item associated to the assets held for sale and one for the liabilities associated to those assets held for sale. What happens in a situation where, in year 1, an entity has a non-current asset held for sale? However, in year 2, the market might change or circumstances might change and the entity decides that it is no longer going to dispose of that asset. In accordance with IFRS 5, it then says that you need to cease to classify that asset or the disposal group as an asset held for sale. This now means that you have to reclassify that asset out of your IFRS 5 category back into the appropriate category to which that asset originated from. So in other words, if it was an item of property, plant and equipment, you now need to move that asset back into the property, plant and equipment category. This is also going to give rise to some remeasurement of that asset. You then go and measure the asset to the lower of its carrying amount before the classification as held for sale, adjusted for any depreciation or amortization or revaluation that would have been recognized had it not been reclassified as held for sale, and its recoverable amount at the date of the decision not to sell. In other words, you need to go back and work out what would the carrying amount of the asset have been in the normal course of business had that asset not been treated as a non-current asset held for sale. In other words, property, plant and equipment, go and look at its carrying amount less subsequent depreciation, etc., and also consider whether or not there have been any indicators of impairment which might have resulted in that asset being written down to its recoverable amount. So what does this mean from a presentation perspective? So remember, on your statement of financial position, you do not restate your comparatives. So therefore, at the end of the first year, when that asset met the criteria and it was expected to be sold and it was classified and disclosed in accordance with IFRS 5, if in year 2 there is now a change in the plan to sell the asset, you do not go back and restate your first year's disclosures. So your first year's disclosures are still going to show the IFRS 5 classification. The reclassification is only going to impact year 2's statement of financial position. IFRS 5 requires an entity to present and disclose information that enables the users of the financial statements to evaluate the financial effects of discontinued operations and disposal groups of non-current assets or disposal groups. So up until now, I have mentioned what is the disclosure impact if there is a non-current asset held for sale or a disposal group on the face of the statement of the financial position. There should be additional disclosure in the notes supporting the primary statements detailing what assets make up that line item of non-current assets held for sale, similarly the liabilities if there is a disposal group. The level of detail, it is going to be driven by the materiality of that item, of that asset, or of the items making up the disposal group held for sale. But we need to remember that the objective of that disclosure is so that a user is able to evaluate the financial effects of the disposal and of the discontinued operations. What we have previously been spending time on is ultimately what is the accounting consequences if there is a non-current asset held for sale or a disposal group, which, as I've mentioned, is going to impact the presentation on the face of the statement of financial position. Where there is a discontinued operation, this is just going to require or result in different presentation and disclosure on the face of the statement of profit and loss and other comprehensive income. What does the standard require? It states that there should be the disclosure of a single amount in the statement of comprehensive income made up of the post-tax profit or loss of the discontinued operation and the post-tax gain or loss recognized on the measurement to fair value less cost to sell on the disposal of the assets or of the disposal group. So in other words, all the income and the expenditure associated to that discontinued operation is going to be taken out of the relevant line items and is going to be grouped together on a single line item where there is going to be the disclosure of the net income or the net loss associated to that discontinued operation. This disclosure is going to be done for both the current period and the comparative reporting period. It further requires that there needs to be an analysis or a breakdown of this single amount into the relevant items making up that amount. So in other words, there needs to be disclosure of the revenue, expenditure, pre-tax profits and losses associated to that discontinued operation, as well as any gain or loss on the remeasurement of fair value less cost to sell, and any related income tax expense. This disclosure might be provided on the face of the statement of the profit and loss and other comprehensive income, or it might be disclosed as part of the note to the primary financial statements. Additional disclosures on the face of the statement of profit and loss and other comprehensive income is going to be the income attributable to the owners of the parent and to non-controlling interest to the extent it is relevant. It needs to be split between income from continuing operations and income from discontinuing operations. In addition, IAS 33 requires earnings per share to be disclosed on the face. To the extent there is continuing and discontinuing operations, your earnings per share then would need to be split between that from continuing operations and that from discontinuing operations. The last primary statement, which we have not considered, is the statement of cash flows. So it is necessary for the cash flows associated to a discontinued operation to be separately disclosed within each of the categories of the statement of cash flows. So you should see a single line item dealing with the net inflow or outflow of cash flows from operating activities associated to discontinued operations, similarly one in investing activities, and similarly one in the financing activities. As I've mentioned previously, from a discontinued operations perspective, it is necessary for both the current period and the comparative period to be represented. So you would see a discontinued operations line item for both the current period and the previous reporting period. I mentioned this briefly earlier, what happens in the situation where there is a change in the plan to sell. The question is, from a disclosure perspective, what is the situation? So, as I mentioned earlier, if there was a non-current asset held for sale in the first year and in the second year a decision was taken not to sell that asset, it would be necessary to reclassify that asset back to its appropriate category. I mentioned already that there is not going to be the representation of the comparative period. In other words, the comparative period is still going to contain that non-current asset held for sale disclosure. It is only in the relevant or in the year 2 disclosure in which there is not going to be a non-current asset held for sale line item presented on the face of the statement of financial position. In the situation of a discontinued operation, so this is where there is the impact on the face of the statement of your profit and loss and other comprehensive income, your comparatives will be reclassified. So in other words, if in the first year there was a discontinued operation and in year 2 there was a decision taken not to sell, the reclassification of those items of income and expenditure back to the respective lines in the statement of profit and loss and other comprehensive income are going to be done for both the current period as well as for the comparative period. So in summary, if there's a change in the plan to sell from the perspective of a statement of financial position, you do not represent the comparatives. However, in the case of a discontinued operation, from the perspective of the statement of profit and loss and other comprehensive income, you will reclassify or represent your comparative information for the effect of that reclassification. There are additional narrative disclosures which are required in accordance with IFRS 5. The description of the non-current asset or the disposal group which is being held for sale, a description of the facts and circumstances of the sale leading up to the expected disposal, the expected manner and timing of that disposal, the gain or loss recognized on the held for sale classification, if applicable, in other words, if you are going to be applying IFRS 8, the reportable segment to which that non-current asset or the disposal group is presented, and if there has been a change in the plan to sell, a description of the facts and circumstances leading up to that decision and its impact on the financial statements. When I opened up the session, I mentioned that IFRS 5 has been a long-standing IFRS standard. There has, however, been a recent amendment which has been made to IFRS 5, and this amendment is an interaction between the disclosure requirements of IFRS 12 and that of IFRS 5. IFRS 12 is the IFRS standard which provides disclosure requirements for investments in other entities. So in other words, if you're a parent and you have investments in subsidiaries or you have an investment in an associate or joint venture, there are no disclosure requirements contained in the relevant standards which deal with how to account for those investments. They are all contained within IFRS 12. The question arose, what happens if there is an investment in a subsidiary, for example, which has been classified as held for sale by the end of the reporting period? That investment in the subsidiary meets the criteria in terms of IFRS 5, so therefore IFRS 5 is going to be applicable to its classification and its measurement and its presentation, etc. However, at the end of the reporting period, if the disposal transaction has not taken place, the group is still exercising control, which means that that investment still is considered to be an investment in a subsidiary. The question is then, is the IFRS 12 disclosures associated to investments in subsidiaries, are those disclosures then still required because the asset is now sitting as an IFRS 5 asset? So the amendment which has been made, it states to say that in a situation where an investment is classified as an IFRS 5 non-current asset held for sale or a disposal group, it is to say that the IFRS 12 disclosures are still required. The only exception or relief that has been given is that the summarized financial information associated to that investment are not required. What this means is that IFRS 12 in certain instances required there to be summarized financial information from a subsidiary investment where there was material non-controlling interest, or in the cases of material investments in associates, IFRS 12 required summarized financial information to be presented in the group financial statements. Where that investment is classified as an IFRS 5 asset, the relief is now to say that, yes, the IFRS 12 disclosures are required in addition to the IFRS 5 disclosures. However, that summarized financial information need not be presented in the financial statements. That brings about an end to our session on IFRS 5.